Will the next panelist please come forward? And as they do, I'm going to introduce the moderator, Scott O'Malley. Scott, again, thank you to ISTA. ISTA is co-sponsoring this forum with us, and Scott is currently the Chief Executive Officer at ISTA. He's located in his London offices of ISTA. Scott served as the Commissioner of the Commodity Futures Trading Commission from 2009 to 2015. Importantly, from my perspective, Scott was the staff director of the U.S. Senate Energy and Natural Resources Committee under my old boss on the Hill for many, many years, and that was the late Senator Pete Domenici. He's a fellow Hoosier, born in Indiana, and we welcome you, Scott. We welcome ISTA, and we hope that we can move forward here with a quick panel discussion. So I'll let you introduce the panel. There will be time for questions. Please get your questions ready. Don't wait till the end of the panel before you start putting together. Go ahead, Scott.
Thank you, Bill. Thank you to BPC for hosting us this morning. This is a very important question. I think that the chairman touched on it. Bill touched on it. Let's kind of revisit the bidding here. U.S. dollar, LIBOR, and Euribor represent over $150 trillion on a gross notional value outstanding basis. And they make up probably 80% of the total $370 trillion in outstanding notional here. This is a very big problem. It's not only in derivatives, but cash products, as was noted by the chairman, and some of the things that Bill mentioned. Banks issue and corporations issue floating rate notes and callable debt. The buy side invests in these bonds and securitization products, and CCPs use LIBOR to clear and reference trades in their cleared interest rate swaps environments. And we have a whole host of asset-backed securities and securitized products, many of which we're going to hear from the next panel on how they're involved in the economy today, all the way down to commercial and residential mortgages. So $370 trillion exposure to LIBOR. The official sector has been on this issue to transition off of what is a fragile survey-based rate to a more robust transaction-based rate. And beginning back in 2012, with the Wheatley report, identified some of the problems. We had several prosecutions, and then IOSCO proceeded in 2013. A number of other, each of these jurisdictions, led by the Fed here in the U.S. with the ARC establishment in 2014. Japan, the UK, the EU, Switzerland have all set up transition and reference working groups to get off of LIBOR and develop a new risk-free rate. So we've kind of found ourselves here in 2017. We had Andrew Bailey's announcement that LIBOR will not be compelled to be submitted past 2021. That's kind of the shot heard around the world, if you will, and really crystallized everybody's view on that we better develop a plan. We better develop it quickly. So 2018 is all about education, and we're grateful that the chairman was here earlier. We have Commissioner Benham following this, but this panel, all the work that we've been doing at ISDA to identify and make people aware. If you have any questions whatsoever, you can simply go to the ISDA website, isda.org, type in benchmarks, some of the important roadmaps and level-setting issues that we've produced a couple of reports that I think are very informative, talking about the scope and scale of LIBOR, what is being done at each of the official sector levels, and kind of the solutions that are being considered today. We've also conducted a survey to reach out to over 150 participants in the market on a global basis to understand what they are doing and how they are preparing. The good news is they are taking the steps necessary. Somewhat concerning is they have a long way to go. And so part of the education effort, we really want to help raise awareness. We have an expert panel here today that can help us kind of walk through these issues. And let me introduce our panelists very quickly so we can get onto the discussion. On the far left is David Bowman, who's Senior Advisor to the Board of Governors of the Federal Reserve. David leads the ARC effort and has been all over this job and is probably the most knowledgeable individual on the face of the earth dealing with benchmarks today. So we are grateful to have David here and has been a long-time Federal Reserve staff member. To his right is Jack Haddam, Managing Director at BlackRock, providing a buy-side perspective. Jack's had several roles at BlackRock, including running co-leading the Alpha platform and heading the global interest rate derivative strategies. And now he's co-head of the Obsidian Fund. Jack also serves on the ARC and is the board member. And then we have Alice Wang to my left, Managing Director, JP Morgan. Alice has tremendous experience within JP Morgan and is involved in leading several key initiatives of strategic importance to the bank and the corporate investment bank, including crypto, blockchain, and LIBOR reform. Alice too serves on the ARC and leads the bank's internal steering group. So, David, let's get to the importance of this and the level setting. You've been deeply involved in this from the very beginning. It's establishing the ARC. Help us provide some context for the exposure where we are today and what needs to happen going forward.
Sure. So maybe just to level set a bit, because probably not everyone spends all their time thinking about LIBOR. So let me explain what it is. LIBOR has been around in some form or another since the late 1960s. Now, when it began, it was really designed for a very narrow purpose, which was some syndicated loans by banks in London. But over time, it grew, and it really has taken off. Use of it really took off over the 1990s and 2000. So we saw this thing that was designed for something fairly narrow that maybe made sense get used more and more into derivatives, floating rate notes, consumer mortgages, until it is now pervasive throughout the economy. And the fact that it could stop is a huge deal. It will be one of the largest changes we've ever seen in financial infrastructure, if not the largest. And as Scott said, there are 5 currencies. It's in sterling and Japanese yen and Swiss franc LIBOR. But dollar LIBOR, which is what I care about most, is by far the largest. It's now referenced in 200 trillion of financial contracts, which is 10 times US GDP. So it's staggering, the amount of use of it. Now, it's produced in London by a company called ICE Benchmark Administration. And how it's produced is 20 banks provide submissions on a daily basis. And what we found is during the financial crisis, there really wasn't a lot of governance around the submissions. A lot of times it was, in retrospect, the administrator just calling a trading desk and saying, quote me a rate. And they didn't have to offer any evidence that that was a good number or the right number, and some people took advantage of that. That governance, has since been corrected from the Wheatley Report and others. But what we found is at the same time that the use of LIBOR has grown, the market underlying LIBOR has been shrinking, especially since the financial crisis. So now, Fed estimates, there might be on a good day, typical day, 500 million in transactions underlying the submissions that these banks make. Might be 6 or 7 transactions, again, on a good day for a good currency tenor pair. So most bank submissions have had to rely on expert judgment. They just have to guess, at what rate they could borrow. They don't have transactions to look at and say, I know what I could borrow at. They have to guess. And what we found is, we've been learning how little activity there really is underlying LIBOR. We've also been learning that banks appropriately really are uncomfortable about guessing, about a number that now is referenced by $200 trillion. So banks, many of them, are deeply uncomfortable in submitting to LIBOR. And that's something that Andrew Bailey, the regulator of LIBOR, has talked about. He's talked about the amount of effort that the official sector has had to put in to keeping LIBOR stable. And I do think that without the official sector's intervention over the past 10 years, LIBOR really could have collapsed before this point. So it's not that the official sector's tried to kill LIBOR. We've, in fact, been trying to keep it alive. And we've seen Andrew Bailey talk about his voluntary agreement with banks to continue to submit through 2021. So, understanding how few transactions there are and how unwilling some of the banks are to continue to submit doesn't take much to see that this is potentially unstable. And this is something that the FSOC has warned about since 2013. And it's the reason that the Federal Reserve, in coordination with many of the other committees, agencies, formed the Alternative Reference Rates Committee, or ARC, in 2014. And what we charged the ARC with doing, it's a private sector group with a lot of public sector encouragement and help. What we charge them to do is first find an alternative to dollar. Find something that's truly robust that could really take this level of activity and take it on shoulders. So identify that rate. Second, identify a plan to promote the use of the rate on a voluntary basis. So there's no regulatory mandate that you can't use LIBOR, no regulatory mandate that you have to use the rate that the ARC has chosen, which is a secured overnight financing rate. We're trying to do this in a very voluntary and market-led way. And the third thing we charged was to think about contract robustness, because what we learned was, even though there's this massive amount of contracts referencing LIBOR, they did not envision the possibility that LIBOR could ever stop. And so if you go look at those contracts and see what happens if LIBOR stops, you're going to find really inappropriate things, like your floating rate instrument might convert to fixed rate, or the rate might jump by 300 basis points, or the contract might not tell you at all what you are to pay or receive. And so these are all problems that we formed the ARC to work through. They made good progress. They did identify the secured overnight financing rate, and they're making good progress on the plan.
Terrific, thank you. Maybe picking up on SOFR, Alice, obviously, as David pointed out, there's 5 other jurisdictions. SOFR is one rate, like dollar LIBOR, Euribor. How is this going to function? How do you guys think about transitioning from LIBOR to SOFR, and how's it maybe slightly different than some of the other risk-free rates?
Well, I just have to say, following the renowned experts, this is unfortunate for me, but
We all stand in the shadow.
exactly. I'll try to do my best. I would say that for the dealer community that works internationally, of course, we've been involved in many of the working groups similar to the ARC in the other currencies, and I think that that's one of the strengths, quite frankly, of the new rates, that the market participants have all been heavily involved with the public sector, and that they've all focused on the new rates and the development of the new rates, quite frankly, with the same principles in mind. I think that if you look at the dollar rate as well as the other currency rates that are coming into being, you can see that everyone has leveraged a robust overnight market. Everybody has focused on the IOSCO principles. Everybody, again, has focused on the broad swath of market participants in developing the rate, discussing the rate, and working through, quite frankly, the complexity of transitioning to these rates. I think that, practically speaking, for participants like ourselves, the internal and external educational processes that we're going through, as well as the large-scale programmatic processes that we're going through, actually, again, go to really the heart of the matter that everybody has brought up thus far, which is this is a very, very difficult process for everyone, and it is a tough road, but quite frankly, the more communication, the more collective thought, the more ability to work together with our customers as well, is going to yield probably the best result in the end.
Yeah. Jack, from a buy-side perspective, how do you think about this transition? What are the big stumbling blocks maybe that you see that we have to overcome immediately?
Sure. Listen, from the buy-side perspective, it's not dissimilar from what's already been said. It's just an understanding of the large complexity that we have at hand. I think as we evaluate where we are and where we need to go, I think the market needs to basically it's 3 stages. It's having an awareness of the problem. I think we're well beyond that. There's an assessment stage where we actually have to go in and see what our exposures are to LIBOR. And as previously mentioned, LIBOR is embedded throughout the economy and has a lot of different uses for the economy. So it's a large thing, and you need to understand where everything is. Then you need to move to that 3rd stage of actually preparing. Stumbling blocks that I see, it's amidst all this education and awareness, you actually have to now start to take some action. You can't wait till the last minute, because if you experience some sort of cliff effect, that, to Chair Clayton's point, that's where you have a market disruption. So this idea that the market is now evolving into actually making real preparations to think about not just the broad strokes of, okay, there's this thing called LIBOR and there's something called SOFR and we should transition, really having a higher quality of content of the discussions. I found the dialogue has increased, but the content, the substantive content of these conversations has really increased, so that people are actually thinking about some of the mechanics, so that we don't wait for the last minute. What we're doing from the buy side perspective is effectively we're evaluating what fallbacks are, as David said, understand what the fallbacks currently are in your existing documents, work on new fallback language, because new products will be printed today that will reference LIBOR. So it's about protecting that new product as well. Then you need to move on to the third stage, which is really going to be appropriate, which is the support of new SOFR-based product.
Maybe Alice, word of warning, Jack works for BlackRock, the most sophisticated, largest buy-side participant. I'm guessing not all your clients are as prepared as Jack and his firm might be. So when you think about kind of stages of awareness, readiness, I hope we're past the denial stage, but how do you see it from more of a Main Street kind of perspective? Because in a firm like yours, you're not only serving big asset managers, but you're also serving some very retail customers. Where are we on the spectrum with some of these other perspectives?
I think practically speaking, for large institutions like JP Morgan Chase, we actually feel it from the client side very directly, because we need to offer products, right? So we need to actually respond to the client needs. We also have our own infrastructure related to the existing client products and the existing client needs that we have to address. So as a result, we see every day the difference between the large players like BlackRock versus the smaller clients in business banking, and our commercial bank and our consumer bank. And we are sensitive to that. We are, one of the things that we are heavily focused on, and it can't be emphasized enough, and I know David has emphasized this quite a bit through the ARC, of course, is the issue of communication. We need everybody to be aware of what is potentially going to happen. Obviously, nobody's got a crystal ball. We can't say for sure on a given date something's going to happen. But we need everybody to be prepared. We need everybody to understand that something is likely to happen. And what are the implications to that? And that, while we can prepare on our side, we can prepare internally our systems, we can prepare new products, we can be prepared to offer things. If the other side, of course, is not prepared, then we're going nowhere. So for our purposes, our own view of preparedness is not only what we're going to do, but what we're going to do to help our clients get ready as well.
Yeah, Jack, you want to say?
And one thing I'll add to that with preparedness and communication is really the understanding of the interconnectivity between all these products. It's not just a US dollar LIBOR issue. LIBOR is cross-product, but also cross-currency.
Exactly. And I would also say, right, that there are people who are involved with the actual product that's referencing LIBOR. There are people involved with the product plus hedges. There are people who are involved in securitizations. There are a myriad of different markets that, to Jack's point, are interconnected. And people really need to be very open and very thoughtful about how they see the market. They can't just look at it in isolation.
Yeah. If you're wondering, ISDA's published a checklist on the things that you need to do to prepare for this. It's in our transition report. It's on our website, so you can look that up to begin to work through your organization to identify your exposure, your maturities, and what efforts need to be taken to help transition your firm. Now, David, Alice talked about a little bit on the consumer side, and the issues of mortgages has come up in these retail products. What is the scope of the exposure there, and how are you helping that transition?
Sure. But first let me say, you can also, just if you Google ARC or Alternative Reference Rates Committee, you'll find a lot of material there. You can get on our email blasts, and we will be happy to inform you about anything the ARC does. So that's another offer to get informed. So the ARC is working quite hard, on all of the products. We've got working groups that Meredith and others will talk about on how do you approach this for loans, and how do you approach this for securitizations and corporate debt. And we do have a lot of Main Street organizations on the ARC. We've got the Independent Community Bankers Association and Government Finance Officers Association and National Association of Corporate Treasurers. But of all those groups, it's the consumers that are the most sensitive and that we need to treat most carefully. So in terms of consumer exposures, no one knows for sure, but my estimates, which seem to be holding up so far, is that there's about $1.2 trillion in consumer exposure to LIBOR, to dollar LIBOR. Now, most of that, almost all of it, is in floating rate mortgages. So chances are if you have a mortgage, mostly it's fixed, and you don't have to worry. You have no LIBOR problem. But if you have a floating rate mortgage, odds are high that it references LIBOR. The other exposure that we can find is there's some amount, about $60 billion as far as I can estimate, in private student loan debt out there. Not really an exposure of credit cards or anything else, so mostly it's mortgages and some student debt. All the government debt, is tied to treasury rates, and doesn't have the same problems to it. So those are the two areas where we see the biggest consumer exposure. And the ARC is building a process to make sure that we treat consumer products with the utmost sensitivity. We've reached out to a number of the consumer groups, consumer advocacy groups, and are having discussions with them. Bureau of Consumer Financial Protection is an ex officio member of the ARC, along with FHFA. So we're trying to set up the most robust process we can to make sure the consumers are not hurt. Now, not everything has to happen through the ARC. People could go off on their own and try other solutions, and I'm sure they would take the same kind of precautions.
Now, David, you'd be the first to admit there's no mandate that LIBOR go away.
That's right. We've, in fact, tried to work hard to stabilize LIBOR.
Right. And a lot of steps, as you noted, have been taken to make it a more robust rate. But the 2021 deadline looming, what is the future of LIBOR? I mean, we're not going to hold you to this, and I'd open it up to the panelists, and this will be my last question before I go to the audience here, so get your questions ready. I mean, how do we think about it? Will it be used in fewer cases, narrow applications, legacy products? How do we think about LIBOR in the future?
Yeah, so I've always said that anyone tells you that they know for sure either that LIBOR is going to stop or that they know for sure it's going to keep going, they don't know what they're talking about, and you shouldn't listen to them. There's no certainty about this. But I will say, from my own perspective, I do think it's very unstable. I do think it is a very hard slog for IBA, the producer, to be able to continue its production in a robust way, for a long period of time. Maybe they could continue to produce it for some time past 2021, but to 2025 or to 2030, very, very difficult. So I do think the odds are high that it will stop at some point. I think it is very unstable. The other thing that could happen is that the regulator of LIBOR could judge it to be non-representative. And they're required statutorily to make that judgment. And the market is so thin that it's hard to see, the odds are high that they could find it's not representative. If they do, that has no direct bearing on U.S. citizens, but it would preclude EU-supervised entities from trading new LIBOR swap or derivative or debt instruments. And that would be very disruptive. It would really make LIBOR much less useful, even for U.S. residents. So I think this is something that people should assume that it is going to happen. You can hope for the best, but you should plan for the worst.
Jack or Alice, perspective on future LIBOR post-2021?
I think, to David's point, it's hard to say. I think it's worth reemphasizing the need for increased education on what's going on and understanding that the new reference rate, as proposed by the ARC, SOFR, has its differences from LIBOR. So, for myself, from a trading perspective, you look at a LIBOR curve versus a SOFR curve, and that we would call a basis. And understanding that basis and those basis risks, and the more we're able to define how those two rates are going to be different, whether at a trading desk and an asset manager or down to Main Street in determining what's the difference if your floating rate switches from LIBOR to SOFR or some other alternative, understanding how that difference is calculated and how it will be calculated is going to go a long way in making a transition smooth.
Yeah, I would just add that I think David's point is the key point, right? Preparedness and risk reduction really thematically are the most important things here. Nobody can really predict the future, but to just sit back and wait and watch really can't be the right answer.
Yeah. Any audience questions? We have two questions over here in the front.
David, it's for you. You talked about today, on a good day, 500 million is done in 7 to 8 transactions. And you also just a minute ago said there's a possibility, if it goes past 2021, that it could be viewed as unrepresentative. What's the potential for before 2021? People knowing that LIBOR is going to go away, that trading diminishes even more than on a good day, it goes down, and that it is deemed unrepresentative prior to 2021. Is that even a possibility?
So there's always risk. You should never make a guarantee that nothing will happen to LIBOR before 2021. But FCA with clear Fed support for this approach, I think have done a good job in trying to ensure that we have this additional period of stability, right? Because people do need it. So I'm fairly confident that we will have a period of stability in LIBOR through 2021. I am pretty confident that banks will continue to submit, and the number of transactions that they have underlying their submissions really isn't affected by any pronouncements from Andrew Bailey or the Fed. It's just how many transactions they actually have, and as I say, most of it is expert judgment anyway, even at this stage. So hopefully I think you can be fairly secure.
We have one down in front here.
I know there's lots of issues with getting the new products out there, but for all the historical, do you expect that once the new products are up and running that counterparties will do a one-off modifications and kind of cleaning themselves up historically one-off, or do you expect sort of more of a big bang, sort of an ISDA protocol or a cross-ISDA-ISLA securitization kind of protocols all happening at a single time and in a single instance?
From my perspective, there's just, given the breadth of all of our client portfolios, there's just no one-size-fits-all solution. The sooner we have some fallback definition of, in effect, what would constitute an IBOR cessation and what that fallback is and what that spread is between the new rate and LIBOR, I think the growth of a basis market then would ease that transition. It actually allows people to have either choose to transition risk at their own pace. You could go down the road of protocol. As long as there's a basis market out there, I think that allows for market function.
Yeah, we didn't really go into the question of fallbacks. ISDA's conducting a fallback currently, and we are working with all of the other trade associations and cash markets, et cetera, to make sure that they're aware of what's going on and the contributions that the industry is making, and we'll work with them on the feedback provided from the market. So this consultation was due to close tomorrow. We've extended that deadline till October 22nd to make sure that we have good, robust feedback on that in order to get broad market-wide adoption. And again, we'll be sharing that with all the other that feedback with all the other trade associations and market participants. We had another question, a couple questions here. We got up front here, second row.
Hi, Victoria Guido with Politico. I just wanted to ask, on the topic of fallbacks. Obviously, there's been discussion about the fact that mortgages are tied to this, and I was just wondering, what is the solution to that? I mean, is the goal basically to make sure that, by 2021, basically, LIBOR isn't being written into mortgages, or is there some kind of, broader solution that? I mean, I don't even know who would be part of that agreement, unlike ISDA, which is a lot more straightforward. How are you all thinking about mortgages specifically?
Could I follow up? Ms. Bill, could I follow up on that? I had a question. This is probably naive on my part, but could a contract being written on a mortgage say either or for 2021?
Well, okay, I'll try to address those two questions. So, I think in all products, you really should be looking at whether you need to keep using LIBOR, whether at least there's some trades where you could not do that because it's so much simpler. The way I think of it is, it's true so for starting, and that's definitely true, got to build it up. But LIBOR may be stopping, and starting is probably better than stopping and simpler to handle. So, I think mortgage lenders probably will look at, whether they can offer other products besides the LIBOR. I assume they are looking at that. But in terms of the legacy contracts that have already been written, there is a mechanism. This is partially good news in that if LIBOR stops and you have a LIBOR arm, your lenders or the note holder of that arm has the right to name a new rate. So there is a mechanism for naming a new rate in that contract. And as been talked about, we just need to make sure that that process is as smooth and as fair to consumers as it possibly can be, so that whatever the rate is, the consumers do not pay more. Now, as to your question, it could be either or. I mean, it could. I think for consumers, probably too much choice is going to be confusing to them, and we don't want to do that. So I think the way I would hope it would work out is there be a clear, very coordinated, at least certainly within the ARC process, we would have there be, process of explaining to consumers what's going to happen. If you choose to move to a SOFR contract, what is SOFR? If LIBOR does stop, how would your new rate have compared to the old, and and clear transparency around the process.
We have time for one more question. You can pick them.
Let's continue the topic on mortgages, actually. The reason I say it's very exciting because it is tied to a 12-month LIBOR. But one aspect is if you were to take a mortgage out right now, and I was on a personal note doing that myself and shopped around the marketplace, if you were to ask lenders out in the marketplace, they are still offering an ARM product, as they should, but they're not putting in language or even putting any fallback, I would say, in that. Is that something we should be concerned about? And as well as, given that SOFR is an overnight rate, what is the thinkings of something coming out for a term rate?
Right. So as I said, there is a mechanism in the ARM now, and that LIBOR stops. The note holder does have the right to name a new rate, and we just need to make sure there's a fair process around that if that's how things go. With the ARC, we have consultations out for fallback language for other products at the moment, and we had guiding principles out. And those guiding principles talked about the fact that there maybe need to be an iterative approach, right? We'll do the best we can on fallback language now, but maybe we'll learn more in 6 months or a year, and maybe we'll need to iterate again. That's something you probably do not want to do with a consumer product. You do not want to say, oh, okay, I tried, but now I'm back again, and here's new language. So I think there's more pressure to make sure you really get it right the first time, which is why, within the ARC process at least, consumer products are going on a slower track because we really need to make sure we get it right. I think what mortgages could go to, there are different rates that they could go to. I mean, within the ARC process, it would be some version of SOFR. It could be an average of SOFR. I think there are different models of that. It could be the term rate that the ARC has talked about, but that will be very far off from now and not necessarily, soon enough to have a lot of that kind of issuance, before LIBOR potentially stops. So these are all issues I think that lots of people are thinking about at the moment.
David, you want to mention that the consultations on the term structure just real briefly, and then we got to close.
Well, right. So we have consultations, and Meredith will talk about this in CIRA. So we have consultations on fallback language for floating rate notes and for syndicated loans. And we will have consultations for bilateral loans and securitizations fairly soon. These are consultations so that the ARC can make recommendations for safer language for those products. It will be on a voluntary basis. People can take it or not take it or take the parts they like. But we are trying to help the market get to a safer place.
Well, we've run out of time. Please join me in thanking this panel and get ready your questions for the next panel. So thank you.